Your balance sheet contains all of the assets, liabilities, and equity of the organization or company as of a given point in time. So the assets and liabilities and equity of the business as of a point in time. So assets are what your business owns, liabilities, what your business owes, and equity, who owns the business, and the cumulative income or loss of the business. When I own a business, I have assets. It's part of my balance sheet. So the assets are meant to grow the business. Again, they're included on the balance sheet. If I'm going to increase my assets, I'm going to debit the assets. To increase my assets, I'm going to debit the assets. The assets are broken into current assets and long-term assets. Current assets are consumed in 1 year or less, and long-term assets are used for longer than 1 year. And I'm going to give you some examples of that in the next slide. To record an asset, again, I'm going to debit the asset. And an example of current assets would be cash, accounts receivable, inventory, prepaid expenses, and an example of long-term assets. So these are assets that are going to be in the business for longer than 1 year. So that would be something like building, equipment, land. So those are examples of long-term assets. Liabilities are what the business owes as a matter of doing business, and my liabilities are on the balance sheet. I increase my liabilities by crediting the liabilities. So as I'm recording my journal entries, if I am recording something like accounts payable, I'm going to credit accounts payable to increase it. I have both current liabilities and long-term liabilities. This is similar to what I refer to in my assets section of my balance sheet. My current liabilities should be paid in 30 days or anyway under 1 year, but most vendors won't let you hold their liabilities out there, their accounts payable out there for typically more than 60 days. So most of the time you want to pay your vendors in 30 days. Long-term liabilities, those are debts that we owe over a period of longer than 1 year. So longer term liabilities are things like mortgages or notes payable. Again, I'm going to increase my liabilities by crediting the liabilities. So I talked about current and long-term liabilities. Again, these are part of my balance sheet. My current liabilities are going to be things like accounts payable, salaries payable, accrued expenses, and my long-term liabilities would be notes payable or mortgages payable, anything that is due for longer than 1 year. And equity reflects the ownership of the business. So if I'm the owner of a business, whether it's a sole proprietor, a partnership, a corporation, if I'm going to put money into the business, then it's going to be reflected as a credit to equity. If I put money in, it's a debit to cash, credit to equity. If somebody buys part of my business, then they would share in the equity. So it reflects the amount of ownership of the individual's, partner's, corporation, and also the accumulative amount of income or loss from the business operations and activities, which is reflected as retained earnings. As a quick quiz, what are the 3 primary financial statements? Is it A, the balance sheet, the statement of liabilities, and the income statement? B, the statement of assets, the statement of liabilities, and the income statement? C, the balance sheet, the income statement, and statement of cash flow? Or D, the asset sheet, the statement of liabilities, and the statement of cash flow? If you guessed C, the balance sheet, the income statement, and the statement of cash flow, congratulations, you are correct. So when I say the balance sheet balances, what I mean is that assets equal liabilities and equity. Assets equal liabilities and equity. And so why is this? Because when I record a journal entry, I must record a journal entry that balances. My debits have to equal my credits. And my balances are always as of a certain point in time. So when I record an activity or something that occurred in the business, as far as a transaction, my debits always must equal my credits. And that's why the balance sheet always balances. It's funny. I have a business owner that has had her business for at least 20 years, very successful, and said she just found out why her balance sheet balances, or the fact that it does balance. So I don't want you to get to that point where it's 20 years down the road and you're just really realizing this. The balance sheet is supposed to balance. Your assets should always equal your liabilities and equity. The books of any business is called a general ledger. The books of your business is considered to be a general ledger, whether it's in the computer or on paper. Whenever a transaction is recorded in your business, it is recorded in a general ledger. This is very old accounting practice. And when I record a transaction in my general ledger, my debits must equal my credits. There are two sides to every entry. The debits have to equal the credits. And this is recorded as a journal entry. So when I get my balance sheet, my income statement, my statement of cash flow, the balance sheet and the income statement comes from the general ledger balances. Any entry I need to record, I use a journal entry and I do what is called posting that journal entry into a general ledger. And the general ledger includes my chart of accounts. What is in my chart of accounts? It's a listing of all the accounts that I would use for any activity in running my business. So all my asset accounts, cash, accounts receivable, inventory, all my liability accounts, accounts payable, accrued salaries, all of my income accounts, revenue, my expense accounts, all of these are in my chart of accounts. So I suppose you're wondering what this looks like. If I deposit $200 in cash from a sale of whatever I'm selling, I'm going to debit cash and credit sales or revenue, and this is what the journal entry looks like. The owner of the business needs to put in $500 into the business, so we debit cash for $500 and we credit equity for $500. And notice the two examples that I have shown you both balance, debits equal credits. In this example, I sell something for $100, but I do not get cash for this. Instead, I record this as an accounts receivable. So I debit accounts receivable and I credit sales or revenue. And so again, it's clear that the debits equal the credits, and this is what the journal entry would look like when I record this transaction. In this next example, I have an expense of $50 for salaries, which I pay for in cash. And the journal entry is a debit to salaries, which is an expense. If I want to increase an expense account, I debit the expense, and I'm decreasing my cash. So I'm crediting the cash. Again, debit to increase the expense, credit to decrease the cash. I know you're getting excited about what this is doing to your general ledger. I'm recording all of these transactions, and you're going to see with an unimaginable amount of excitement what is going to result from all of these transactions. So in this case, I get an electric bill for $50. So I debit the utilities expense, and I didn't pay it yet. So I'm going to credit accounts payable. This tells me that I owe $50 for this bill. So I'm recording the expense, but I haven't yet paid it. So the journal entry is still a debit will equal a credit, but there's no cash that's gone out of my system yet, no cash that's gone out of my bank account, but I am recording this transaction. This is considered accrual accounting. In this example, I get a bill for rent, and I'm going to again debit the expense, which is debiting rent expense, and I haven't paid it again, so I'm going to credit accounts payable. So this journal entry affects both the income statement and the balance sheet. The income statement, rent expense is part of the income statement, right? An expense is part of my income statement, and accounts payable is part of my balance sheet. So this is impacting my income statement and my balance sheet. So I debit the expense, which is increasing the expense, and I credit my liability, which is increasing my liability. This is so exciting. You had a chance to see in action how journal entries are created and used. The journal entries that I showed you, all of them balance debits equal credits. If I had more lines on any of the journal entries, it would still have to balance. I could have 3 lines as debits, 3 lines as credits, or 5 lines as credits, but the debits would need to equal the credits. Once the journal entries are posted or recorded in the general ledger for any time period, say we're talking about a month, then I can take the totals for the month and create the balance sheet, the income statement, and the statement of cash flow. This is so exciting. This is the result of those most recent transactions that I was talking about. Cash ends up being $650 if you add up all the transactions together that I just reflected on, and it's in the PowerPoint. I get cash of $650, accounts receivable of $100, total assets $750, accounts payable $90, equity is $660, which is a combination of the equity the owner paid in and the result of retained earnings from the income statement. And so you can see that my assets equal my liabilities and my equity. Isn't this exciting? This is my balance sheet. So the examples that you have seen in the previous slides show you how a balance sheet is created. So cash consists of the owner's deposit and then the deposit for the sales less salaries paid. Accounts receivable was created from a sale. All entries balance, so my debits equal my credits. And my general ledger, if I total everything in my general ledger, it equals 0. Why? Because everything that goes into the general ledger, the debits equal the credits. So my general ledger totals, the totals of all my accounts, the cash, the accounts receivable, the accounts payable, the revenue, the expenses. If you total all of those things together, the total is 0. Again, going on to how my balance sheet was created, my accounts payable was the accumulation of my rent payable and the utilities expense that I reflected the expense, but I hadn't paid it yet. And this is accrual accounting, and the whole point of accrual accounting is recognizing expenses, revenue and expenses in the period in which they are incurred. So in this particular situation, I want to make sure that I recognize the rent expense and the utilities expense in the period that it is incurred. So the equity is the owner's deposit plus retained earnings, which is the net income of $160. So all of my entries balance my debits equal my credits. And again, if I total every single account in my general ledger, the total would be 0 because all my debits equal credits. Here's the fun part, and I know you know the answer to this one. The important component of a journal entry is A, debits must equal credits. B, it must include assets and liabilities. C, it must not include the balance sheet, it must include the balance sheet and income statement. And D, it must not balance. You are so brilliant, and you're absolutely right. It is A, debits must equal credits. You are correct. So as you saw in the previous slides, I create a balance sheet from recording the transactions of the organizations through journal entries. So I record my accounts receivable and the revenue, I record my expenses. Any transactions that are part of the activity of my organization are recorded in journal entries and then are reflected in the general ledger, which then is turned into the balance sheet and income statement. So then I'm going to adjust for any non-cash items. and I'm going to do that through reconciliation journal entries. So I increase my assets, those are debits. I credit my liabilities to increase my liabilities. My equity is typically a credit. So what does this mean? When I record reconciliation journal entries, I might reconcile my bank account and put through some bank charges. So if I'm going to do that, I'm going to debit bank expense and credit cash. So I might need to record things after I've actually recorded the revenue and expense items in my balance sheet and income statement, or in other words, in the general ledger. I might need to make some additional journal entries to show transactions that are not reflected in the operations. When I record journal entries, I do what I call posting the journal entries in my general ledger. So the general ledger consists of cumulative journal entries to each account. And as a result, I will take the assets, liabilities, and equity accounts and record them and reflect them in my balance sheet. And I will take the revenue and expense accounts and reflect those in an income statement. When I total all of my general ledger accounts, they will equal 0. And that is because every time I post a journal entry, my debits equal my credits.